We are back with our featured guest, Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Diana, you and I were just talking, during the commercial break, and that it's difficult really to know when to sell. You always really want to sell or trim at the top. It's difficult, and we feel, when you take a look at the markets and the movement, you feel like it's at the top, but if you go back to our previous conversation in the previous segment, things still look pretty good.
Where is the top? We don't know where is the top. If we knew where is the top, it'd be such an easy business. But it's not about picking the top. It's about making money. And it's about minimizing your losses.
Well, that's my concern, right? Minimizing your losses. Therefore, don't you have to pick the top?
No. No. If you bought something at $10 and it went to 20, and then you didn't sell it, but it went back to 17, did you make money? Yes.
Yeah.
You made $7. You didn't make 10. But you made 7. Mm-hmm. And where you put the money when you sold it at $17 also matters.
Yeah.
And maybe it continues to go down to back to 10, but then you took that $17 and you put it in something that went back to 19. So yes, you could have sold something at 20. You didn't, because you didn't know, because hindsight's 20/20.
Right.
So it's about limiting those losses. It's about knowing where. It's about doing that which keeps you comfortable staying in the market. So for example, if you're fully invested now, you have your levels where you would sell certain things, how you would do it, why you would do it, you have your reasoning. You're now comfortable to stay in the market. What's the worst that can happen? Something comes off the top, but it keeps you invested calmly, as opposed to constantly being fearful of why I should be selling today.
But you have a disciplined sell approach.
Yeah.
And so what is it? And I know it would be different for every sector and stock, but on average, is it, if you see something down 10%, 5%, what is it?
Well, it depends, because it depends on where you bought it. It depends on the temperament of the stock and how much you're in a profit. And then it also depends the reason why you sell it. If you lost money on the position, but you see something else working, you would sell that position, take a small loss, and move the money into something that you could be making money. The stock market doesn't know that you bought the stock higher. It doesn't need to return it to you. The stock will do what it will do. So if for example, we're in a strong profit position, then we're going to sell it when it stops working relative to somewhere else, because it's a two decision. One is where it's not working, and B is what's working better. Why am I not making money here and I could be here?
Diana, for our viewers listening to this and recognizing it, and recognizing this is what you and your team do all day long.
Yeah.
And that's really what it takes. How do you dovetail that with the Warren Buffett method of buy and hold? Now, mind you, I do believe that a lot of his buy and hold companies are companies that he's owned for so long. They are core positions, and many would say he hasn't had as much success with his stock picks. Now, mind you, I think it's a couple of other individuals that are picking those stocks, but they're not his core positions in terms of the real estate that he's in or the insurance companies. But that whole buy and hold strategy, how do you dovetail that kind of thinking with what you're saying? Where's the disconnect?
So two things. One is markets, I think, have changed over the decades. And there's the possibility for a lot more volatility at times, but also a huge amount of interconnectivity between markets globally. That's number one. Number two, I think psychology plays a lot into it. So it depends where you are in your income cycle as well. Oftentimes, we sell at the wrong time. Absolutely the wrong time, because that's the most fearful time and you can't afford to lose. So academically, we can always look back and make decisions 20/20. But when you actually have money in something and you've lost a lot of money and your bank calls you for margin, sometimes you just sell at the wrong time when it feels the worst. So you have to do things to your portfolio that keep you comfortable staying in so you can sustain certain things. Now, psychologically, sitting on a losing position is different than a gaining position. You always want to book your profits and you feel really smart. And when you're down on something, you're not objective. You want to be right. You give yourself all kinds of narratives why you were right and you will be right and so forth. And so there is a tendency to choose information that reinforces your view in a subconscious manner. That creates big losses, and frankly, big losses is what hurts people most because they just can't get back in. You know that $5 on 10 is different than making 5 on 5 from a mathematical perspective. You lost 50%, you got to make 100% to make it back. So it's, stairs up, elevator down.
Let me ask you then, in terms of looking at the TSX, because we are looking at record highs, are there areas that you would want to take profit in today? I mean, I know that you're fully invested and that you've gone back into the energy sector and overweight the energy sector, but are there areas you want to take some profit in?
That's an interesting question. So we were underweight energy, and we have increased energy in some portfolios as high as 10 to 12%. Now that's still underweight the TSX, but it's overweight the S&P. Where did we take that money from? Some of the names, it wasn't a particular sector that we took down. It depended on what stocks may have less of an upside performance or that sort of thing. So, in Canada, we're still, one of our top 10 holdings is one of the Canadian banks. Top 10 holdings also holds some technology, so banks, technology, and now energy as well as industrials. So if technology was at some point 40%, it's now 30%. To make room for the 10 to 12% energy. And so from a perspective of portfolio, you have a kind of a heat map where you're channeling money from stocks that whose upside momentum stopped into something that seems to be acting better, and we'll see.
Diana, this is interesting when we're taking a look at the Canadian banks. Maybe we can go back to the Canadian banks for a moment. TD is up on the day. The rest of them are trading a little bit lower, mildly so. But do you believe, as we head into earnings, that they still have more upside?
Somebody said to me, one of our analysts at the office said something very interesting. The new mortgage rules actually allows the banks to have more customer stability, in the sense that if you have to get approved for an X amount of percentage on your mortgage, it become harder to get a mortgage. You'll stay with your bank as opposed to start bank hopping, which will then maybe create less of an upside to more rate competing and that sort of thing, and so it's a lot more stable. There is one side. The other side is that
lower volume, likely lower volume.
Lower volume, but the margin, on the margin it might be okay. You're right. So we'll see how that works out. But energy is working. That tends to help. And while we had a correction in the housing market, which is not surprising, it feels like things have stabilized a little bit. We'll see what the earnings come to. Don't forget, last quarter was a great outperformance relative to expectations and actual earnings, but not just relative to expectations. And now the expectations are elevated. So we'll see.
Can't believe we have to leave it on that note. That's not good. That is not good, Diana. All right. Thank you very much. Appreciate it.